Joseph is an Australian resident taxpayer with income and expenditure from both Australian and foreign sources. Joseph has paid foreign income tax on his foreign income and may be eligible for the foreign income tax offset for the tax already paid. Generally, the amount of foreign income tax paid is available as a foreign income tax offset. However, for amounts over $1,000, the offset is subject to an offset limit or cap. To calculate the offset limit, Joseph first calculates his Australian income tax on all taxable income. He includes income from all sources, subtracts available deductions, calculates gross tax payable, and then adds relevant levies. Next, he calculates his Australian income tax on only the Australian-sourced taxable income. Here, Joseph disregards the foreign-sourced income and related deductions and calculates gross tax payable and then adds relevant levies. His foreign income tax offset limit is calculated by subtracting the Australian income tax on Australian sources from the Australian income tax on worldwide sources. In this case, his offset limit is less than the actual amount of foreign income tax paid, and unfortunately for Joseph, the difference is not refunded or carried forward. Taxpayers may be eligible for a foreign income tax offset on tax they have paid on foreign income. There are three key requirements that must be met. Firstly, the foreign tax must have been imposed on foreign income, profits or gains by foreign law. Secondly, the foreign tax must have been paid rather than simply accrued. Thirdly, the foreign income relating to the foreign tax paid must be included in the taxpayer's assessable income. The foreign income tax offset is based on the amount of foreign income tax paid. If the foreign income tax paid is up to $1,000, then the actual amount of foreign income tax paid can be claimed as the offset. If the foreign income tax paid is more than $1,000, the taxpayer can either claim $1,000 as the foreign income tax offset or calculate the maximum foreign income tax offset, taking into account an offset cap. This cap limits the offset to the amount of Australian income tax that would have otherwise been payable on the foreign income. There are three steps to determine the foreign income tax offset limit. Step 1 involves calculating the Australian income tax on all taxable income, including Australian and foreign income and related deductions. Step 2 involves calculating the Australian income tax on only Australian-sourced taxable income, stripping out foreign income and related deductions. Step 3 involves subtracting the Step 2 amount from the Step 1 amount. The outcome is the foreign income tax offset limit, which is the maximum offset that can be claimed by the taxpayer. Where the offset limit is higher than the actual foreign income tax paid, the offset reflects the foreign income tax actually paid. Where the offset limit is lower than the actual foreign income tax paid, the offset is capped at the offset limit, and the difference is not refunded or carried forward to a future year. To recap, taxpayers may be eligible to receive a foreign income tax offset for foreign income tax paid on foreign income that has been included in their Australian assessable income. The offset is generally based on the foreign income tax paid, but is subject to a cap to limit the offset to the amount of Australian income tax that would have otherwise been payable on the foreign income.